You're 35. You make $90,000. You've got a partner, maybe a kid, maybe a mortgage. 5 decisions you'll make in the next decade will quietly determine whether you retire at 60 with $2 million or at 70 with $400,000. These aren't the ones that get the headlines. They're the ones with quiet, compounding consequences nobody tracks until it's too late. Decision 1. Your savings rate. Most people focus on raises. The math says focus on percentages. A 1% bump in your savings rate at 30, that's $900 a year on $90,000, compounds to roughly $130,000 by age 65 at the long-run 7% real S&P return, the inflation-adjusted historical average. A 10% raise at 50, even if you save the whole thing, can't cover that gap. Time, not income, is the lever. Saving 20% of $90,000 from age 30 onward at that same 7% real return lands you near $2.5 million by 65. Wait until 40, and even saving 30% of a higher salary, you finish at $1.7 million. Same person, same trajectory. $800,000 gap, and it didn't come from earning more, it came from starting earlier. Decision 2. Roth or traditional. The conventional wisdom is pre-tax now, taxes later. The smarter take: at 35, you're guessing what your tax bracket will be in 30 years. Future rates aren't guaranteed to be lower. The same $20,000 a year for 35 years grows to roughly $2.7 million either way. The Roth lets you keep all of it. The traditional gets taxed at withdrawal at whatever future use bracket happens to be. Concrete scenario: you're in the 24% bracket today, you contribute $20,000 a year to a traditional 401k, saving $4,800 in current taxes. 35 years later, the account is $2.7 million. If your retirement bracket lands at 22%, the federal tax bill on the way out runs about $600,000. The Roth keeps the full $2.7 million, no withdrawal tax. Roth is a tax rate hedge, and the longer your runway, the more valuable the hedge. Decision 3. When you buy your first home. Buying with 5% down and PMI versus waiting until you've saved 20% isn't a virtue question. It's a compounding question. PMI on a $400,000 home runs about $180 a month and drops off automatically at 78% loan-to-value. Meanwhile, home prices and your locked-in mortgage rate compound while you're saving. In a 4% appreciation market, roughly the Case-Shiller long-run average, buying 3 years earlier puts you $90,000 to $140,000 ahead at the 10-year mark. Patience isn't always free. Decision 4. Term life insurance. This one is purely about timing. A healthy 30-year-old can lock in a $1 million 30-year term policy for around $35 a month. The same policy at 45, assuming you still qualify, runs $100 a month or more. Lock it in early, and your cost is fixed. Wait, and you pay roughly 3 times more for the same coverage, plus the risk that something between now and then disqualifies you entirely. Decision 5. Your career stack. The W-2 path is the default, and it works. But for high-skill workers, the 1099 path stacks 3 things the W-2 doesn't. The solo 401k, with a $69,000 contribution ceiling at the 2024 IRS limit, that's more than 3 times what a typical W-2 employee can put away in a year, including their employer match. The Section 199A qualified business income deduction, 20% of business profit before federal tax. And full deductibility of every legitimate business expense: home office, mileage, equipment, software. At similar pre-tax pay, a 1099 contractor who actually uses these tools comes out roughly $150,000 ahead over 10 years. Most don't, because nobody hands them the playbook. 5 decisions. Made or unmade quietly, while you're focused on the obvious things: the next promotion, the next car, the next vacation. The window is age 30 to 40. After that, every one of these gets more expensive. Lock in the savings rate. Take the tax rate hedge. Move before the math turns against you.